Hi, everybody. I'm Tammy Cranage with Loan Depot. Welcome to another video. Today, we are going to talk about adjustable rate mortgages versus fixed rate mortgages. Before we get into that, for those of you who don't know me, I'm Tammy Cranage with Loan Depot. I've been a lender since 2002, and I specialize in helping my customers integrate their mortgage into their long and short-term financial goals. I help you I act as a manager. I help you manage your payment position, your equity position, your cash flow, and making sure that your mortgage is working for you. You are not working for it. So let's talk about an adjustable rate mortgage and a fixed rate mortgage. Now, there's a lot of talk about the Federal Reserve cutting back on the buying of mortgage bonds. This is known as tapering. So these purchases of mortgage bonds have helped keep the interest rates at these lows. Now, because of this tapering, interest rates are going to start creeping up. People are going to be looking for alternatives, and an adjustable rate mortgage is a great alternative to a higher fixed rate mortgage. So let me give you a demonstration. Let me share my screen here. So this is a demonstration of a 5/6 ARM versus a 30-year fixed rate mortgage. You'll notice that the interest rate on the 5/6 ARM is 2.75 versus the 30-year fixed at 3.5. This is future tense, guys, future numbers. So you notice the difference, same purchase price, same loan amount, $480 loan amount for both, but the difference in the interest rate is a difference of $196. That's a big chunk of change, both amortized over 30 years. So now here's a thought. A lot of people say to me, that's great, but what happens in 5 years if the rates are higher? That's a possibility, but here's another possibility. The rates could be lower. So here's a way for you to manage your mortgage regardless of what the interest rates are doing. You can reinvest this 196 savings. You can actually reinvest it into your principal payment. So if you take that same 480, same 2.75, obligated to 1959 payment, and you reinvest that money, that 196, you will cut down 5 years of interest, well, 4.5. You will go from a 30-year mortgage to a 26.5-ish mortgage, saving you a lot of interest. Let's see how much interest that will save you. So if you go down over here, over 5 years, that's going to save you $18,000 in interest. And look at how much money you will have applied towards your principal, $124,000. So if we click on this more information screen, you can see your loan balance is $355. A lot of things happen in 5 years. You may get a promotion, you may lose a job, someone gets sick, family moves in, family moves out, more kids, less kids. There's lots of things that happen in 5 years, and your mortgage is set up to, I will help you manage your mortgage to help you adapt to these situations that happen in your life. No one stays in a 30-year fixed rate mortgage anymore for 30 years. In fact, the average lifespan of a mortgage is about 5 to 7 years. So maybe if the 5 years is a little too aggressive for you, we can look at a 7-year option, even a 10-year option, where it's fixed for a period of time, whether it's 3 years, 5 years, 7 years, or 10 years, and it's amortized over 30. So a lot can happen in those time periods. But the idea is, first of all, we want to make sure you have a payment you can manage. And second of all, we always want to make sure you have the best equity position. So I hope this helps you make some decisions out there. Those of you who are still looking, don't despair. The right house is out there. And for those of you who are still contemplating refinancing, this might be the last chance you get. Those rates might not have a 2 in front of it, but they're still lower than they've been historically. All right. Thanks for watching. I hope you have a fabulous day.